welcome you today for this webinar on geopolitics and meta trends defining the next decade. And before we formally begin, a few quick housekeeping rules, please. Today's session is for 1 hour. All participants are requested to stay muted and keep their videos turned off. Q&A will be held at the end of the two speaking sessions, so please submit your questions through the chat box. The webinar will be recorded and uploaded on our YouTube channel, and you're requested to fill the feedback form in the end of the session. So as the world becomes more fragmented geopolitically, with power shifted between regions, rapid technological change, AI, and major demographic shifts happening all at the same time, investors are operating in a much more complex and interconnected global environment. To understand these big long-term trends, we are privileged to have with us Dr. Salman Ahmed, Global Head of Macro and Strategic Asset Allocation at Fidelity International. He's featured frequently as an expert on CNBC, BBC, Bloomberg for his strategic insights on economic trends, and he's a very well-known person in Pakistan as well. Welcome, Dr. Salman. Joining him is Ms. Mahin Rahman, CEO, Infrazam in Pakistan. She's previously been a CEO for large AMC in Pakistan as well. Mahin has been featured on Fortune's 40 Under 40 Women to Watch list. She also serves on a number of boards with notable directorships, including SCCP Policy Board, PICG, GSK, and many more. Our Q&A will be moderated by Ms. Naveen Ahmed, who is an investment banking and climate finance expert and a member of Sales Ready as well. So without further ado, thank you all for joining us today. And I'd like to invite Dr. Salman Ahmed to begin the session.
Perfect. Thank you. Thank you very much, Sarah. Assalamu alaikum, everyone. Really pleasure to speak to you today as we try to look into 2026 and beyond. What I'm going to do is, for the next few minutes, just set the scene towards what we are thinking about from a more global and macro and top-down perspective as we look into the next year. The key themes which we have developed are focused on both from an investment perspective and also from a wider asset allocation perspective. But also a few thoughts on the medium term, because 26 obviously is 1 year in this big change, as Sarwat mentioned in her initial remarks, which are in play, and a new world order is coming into shape. Nobody exactly knows what the end state or the steady state of that world order would be, but there are some clear contours developing, especially centered around US and China rivalry. So let me start by, as I mentioned, some of the themes which are more immediate and top of our mind right now. So if you can ask somebody to share the slides. On your side, so
Yes, we are managing that.
Brilliant. Excellent. So if you can go page number 3 on the pack, which is basically the key themes as I indicated earlier. So right now, let's start with the elephant in the room, AI. There's a lot of capital which has been drawn into the space, big commitments on CapEx, and CapEx being done already especially by the hyperscalers. But the angle from a macro side is that AI is not only a market theme, but also a macro theme. You have got a huge wealth effect running right now in the US as a result of the increase in the equity market driven by AI. And if you look at consumption growth in the US, it's mainly driven by the richest households, whilst the lowest income households are struggling. In fact, they've hardly grown consumption over the last few years. So this flywheel, which is running positively, can start to turn in the other direction if there's a big wobble on the AI theme. And the wobble can come from valuations being very demanding, but there are several angles and themes in terms of how the wobble can come into play. We are less concerned about kind of a wobble, which is basically driven by the fact that there's better technology out there which hits some of the bigger names like NVIDIA, because somebody comes up with a better chip. I think the markets can can wear that, although it may create idiosyncratic issues. But more concerning would be, a collapse in the ROI of this AI investment, especially when it comes to data centers. Uh, Again, that could be driven by technology. You get better technology, better software, especially from China tech, which can challenge US in a meaningful manner. So the kind of wobble is important. The issue is that valuations are very, very demanding. And earning expectations are obviously going to the moon, and that's obviously concerning quite a few of our analysts right now. But certainly, this is an issue in the short term. But we do think that the AI thesis itself is a powerful one. It's a real one. It will have geopolitical, geoeconomic implications as productivity gains start to come into play. In fact, 48% of our 180 plus analysts see genuine use cases being developed across various industries and sectors as we move further into 26. So that's the first one. The second one is geopolitical fragmentation and trade tensions. We think that is the new reality. Trade tensions are here to remain centered around US-China rivalry. It's going to become much more clearer now as we go further into 26. That ultimately this is a economic, technological, and security rivalry between US and China. China has played, it very well so far. They have defended their economy through fiscal stimulus, but ultimately do not take for granted any kind of a rapprochement between these two big economic blocks and security blocks. The truth is exactly that, which is basically time for both of them to adjust to a world where they are more or less completely decoupled, and it will have implications for Pakistan as well, and then and some implications on short-sightedness versus more medium-term end of trajectory in terms of where this relationship is going. So again, in 2026, we expect tariffs to remain in place, even though IEPA may be struck down, which is the ruling is due early next year. But there are other ways the US government can build up that tariff wall back to around 15-16%. And we do think that that is going to happen given that $4 trillion of still money or in revenue has already been penciled in CBO projections, and that 4 trillion has already been spent by the US government. The number 3 point is policy support. We think that another fiscal is coming next year. The timing of that fiscal will depend on whether you get an AI wobble or not. We do think that the AI wobble, if it happens, will be protected by the US government because given that they see it as a sovereign issue and a sovereign technology. We've already seen China being taken out from the most advanced chips. Other restrictions are coming in on other countries as well. And we think that more and more restrictions, especially on the cutting edge side, will come through, and fiscal would be needed and will be deployed if there is a wobble, and most certainly before the midterms, given the affordability is becoming a theme in the US once again. How will the bond market react to it will be an important question. We do think that dollar is in a multi-year downward trend as a result of this. It's a currency which is still overvalued. It's being tackled by an administration which doesn't want a strong currency. And for obvious reasons, they want manufacturing to be pushed back. In fact, Pakistan is probably the only country in love with stronger currencies. Other countries I've seen usually want weaker currencies. Excuse me. If you can go to page number 3 again, apologies. On the back. Yeah, thank you. And fiscal and monetary easing is another theme we think is going to play out, especially as a new Fed chair comes into play, which is so Kevin Hessett's name has been taken quite a few times now. That was probably a trial balloon, but he's one of the more creative doves. But ultimately, whoever is the new chair is going to be dovish, and they are going to cut rates. Big question would be if Chair Powell steps down from the governor position. Please remember that his chair position is expiring in May, but his governor position is expiring in January of 2028. So a big question would be whether he decides to stay on and take on the immense political heat as a result of that. But that's something which is a theme for second half of next year. Last point is that from a strategic asset allocation perspective, we think that equities and bond correlations are likely to remain elevated. Traditional diversification is going to become less effective, and that's going to increase the need for alternatives, especially gold. We think that gold is a multi-year upward trend, given that central bank buying remains relentless. We are firmly in a world where countries don't trust each other. Um, you've seen that in the national security document of the US as well, which is starting to now articulate what the US administration is all about. It's much more about geopolitical, geoeconomic, and resource and supply chain security as much as US-China rivalry at score. Europe has been downgraded quite significantly under the current US administration, and that's something, a trend we think will continue, especially given the fact that US administration doesn't see any value from Europe when it comes to US-China rivalry and how they are going to deal with that. So those are some of the uh, points from a broader perspective I want to share. I don't know what happened to our slide pack. Seems to have vanished from our screens. Sarat, are you there?
Yes, very much there. We manage and just
Sorry. Uh, I guess I can continue. So from an asset allocation perspective, as I already mentioned, dollar is our core high conviction theme, which we think is going to continue to weaken going forward. Emerging market equities and fixed income, local currency especially, is one of our uh, high conviction positive ideas, whereby we think you can gain alpha. Um, AI, we want to play that theme from a more broader perspective rather than just the narrow names. Concentration in US equities, as we know, is at all-time high levels. Uh, there are some indications of bubbly kind of dynamics, but we don't think that this is like a 2001 bubble, mainly because uh, of the fact that a lot of these companies who are spending capex are very profitable, um, more or less monopolies in their field, and potentially going to create political and social issues as they go along. But that's for the next administration, and what happens to Democrats, which are more and more getting disgruntled with the way big tech is behaving with respect to the current U.S. administration. But in the short term, a lot of this cash they're spending is based on earnings, and the kind of leverage we are seeing is early stage leverage, although a bit concerning given the complexity of the deals which are being announced, especially centered around OpenAI. But if you look at the overall cash balances these companies are holding are at extremely high levels. A lot of these hyperscalers don't hold much debt. And they're only starting to lever from very low base levels. So that gives us confidence that this may not turn into a systemic issue, if even if there's a wobble. And on top of that, you will get uh, policy support from the US government if there is indeed an AI related issue, given that they see it as I mentioned, a sovereign technology which they need to protect, and will not let a market wobble derail them versus the race they are having with the US. So we also want to play the AI theme again from a geographical breadth perspective. China is doing very well in AI, and we are also long China tech, despite the fact that it has had a good year. Um, because one of the big challenges to US tech is China tech, especially if they continue to build a more better and more efficient software to challenge the intensity of these chips, and challenge the fact that why do you need so many chips if you can build better and more efficient software. So it's much more about diversification, broadening your chips, but we want to stay invested at the same time. Build gold as our core diversifier, uh, effective use of alternatives, especially downside protection in broad and diversified portfolios. And then, as I mentioned, we like EM, especially countries like South Africa, which have gold exposure, China exposure. We like Brazil again after the big sell-offs over the last few days related to political noise there. But local currency wise, Brazil is still offers very, very high real rates. India is something which we are not too keen about this again this year. AI is challenging the Indian IT model in a very big way. And we do think that they are going to be one of the biggest losers out of the AI productivity gains, given that back office and outsourcing models will come under a lot of stress, and they are not at the forefront of any kind of cutting edge AI technology, which tells you that having IT resource is not the same thing as doing IT innovation, which is the very unlike the model China has run and used historically and now bearing fruit. A few points on Europe. Big questions on Europe. What is the growth model for Europe um, uh, in terms of where does it land? I think there are a few slides on Europe. If you go down, yes, that's the one. So there are some signs of some resilience coming through. They have obviously Germany-led defense spending is going to kick in next year. They will need much more than that. They need much more bigger fiscal stimulus. They need an ideas to connect capital with demand for capital. Regulation is always been a bottleneck for Europe, but ultimately US is abandoning them in a big way, especially when it comes to security. And we do think that the Russia settlement, whenever it happens, and it's likely to happen soon, is going to be very much in favor of Russia. And that will give another boost to Europe in terms of what are they going to bring to the table to produce their own tech, produce their own strong growth, given the fact that they have fiscal capacity, uh, skills, industrial base, but they are they ready to change deliver that into sustained growth? So that's again question marks in Europe as we go into 26. But defense spending is likely to kick in and create that upswing. And then lastly, in China, cyclically they've maintained a very stable macro picture, which has allowed them to focus on the innovation areas they have been delivering a lot of good outcomes on, with whether it's EV, renewables, AI. Um, China remains a big exporter. Export has been a big source of growth for them. Export volumes and value to US is starting to come under pressure. But a lot of that dumping is happening in Europe. So the next step of this trade war, we think, is going to be a Europe-China trade war. Despite the fact that, given the fact that China has depreciated its currency against euro, which has made them quite competitive in Europe. So we do think that those tensions will become much more palpable and much more serious, especially if Europe starts putting tariffs on Chinese goods and services as a result of a weak and suboptimally weak currency they continue to run. But if you look at the 5-year plan from the latest 5-year plan from China, they are focused on domestic demand, self-reliance. So those are I think, the more medium-term themes we think will continue to play out for many years to come, whereby US and China start to decouple in a much more meaningful manner. They're already decoupled from a technology and security perspective, but the economic side will continue to come under pressure as every all these big blocks bring their own spheres of influence. We already seen that in US with the Western Hemisphere action going on, a lot to do with resources and oil and energy. Greenland is there, and in China, obviously, they already have had their spheres of influence and supply sides secured. But we would expect more and more moves towards that, and more pressure on countries to start to take sides going forward as that tension continues to build over time. So those are some of the themes and the medium-term trends we are watching. Lastly, on immigration and other areas of interest, which is affecting labor market in the U.S., immigration crackdowns are very popular policies in the US. They are becoming popular in Europe and UK as well. Uh, and we do think that that is going to remain the case going forward. We are seeing collapse of legal migration in a number of countries, including US and Europe. We think that trend continues. Crackdown on student visas and other things are going to escalate. And the major reason is they are extremely popular policies. AI promise is there that it can replace immigration. Remains to be seen how quickly that can come through. But the social and political aspects of that immigration crackdown are very much clear and likely to remain so for many years to come. And that's something I think a big question mark for Pakistan as well, especially the education system of Pakistan, which continues to produce exportable commodities rather than anything to do, or less to do with domestic and self-reliance kind of themes other countries are starting to follow now. So those are some thoughts, both from a top-down macro perspective, some of the meta themes which we are watching, which is AI, deglobalization, and overall global fragmentation and turning of the world into uh, uh, clearer blocks of economic security and technology, where sovereignty of talent, sovereignty of technology, sovereignty of economics becomes much more centerpiece going forward. I'll pause here and give the floor back to Sarwat. Thank you.
Uh, thank you so much. Thank you so much, Dr. Salman, for your insightful presentation. I would now request Ms. Maheen Rahman. Maheen, thank you for joining us today. And I would like you to shed light on how Pakistan can navigate through these meta trends and how we can gain out of it. Over to you, Maheen.
Thank you. Thank you, Sarva. Thank you, Naveen. And very interesting to see your presentation, Dr. Salman. So maybe just take a step back and talk about where Pakistan's currently standing. We are all aware of the journey that Pakistan has been on over the last 2 years. It's very encouraging now to see that we have some stabilization in terms of the macro trends, whether it's interest rates or inflation or growth. Under the IMF program, it has stabilized quite significantly. I think what policymakers are thinking about now is when the program does expire and when we move and graduate out of it, which looks quite likely that we will, how do we as Pakistan ensure that we don't end up under the same IMF program in another 2 to 3 years, which has been unfortunately the case for the last 18 years or so. We have seen approximately 25 IMF programs. So what are the broad trends that Pakistan is currently facing? One, both internally, and two, from a geopolitical and global macro perspective, which has been highlighted by Salman. So I think if I look internally, first of all, there are certain risks which perhaps 10 years ago, those risks were not as severe, but at this point in time, the risks are slowly creeping up, and something which is becoming quite difficult to ignore for us now. The first of all, I would say, is actually the overall geopolitical risks for Pakistan in our neighborhood have gone up quite significantly. We have actually had significant disruptions to logistic supply chains, plus other operations from the sort of war we had with India, from the ongoing escalation in the Middle East, and all of these do disrupt or simply because of our location and our neighborhood. So I think we've seen an escalation in that in the last 3 years or so, and that's a risk that's slowly beginning to filter into a what happens scenario in a lot of boardrooms or a lot of corporate offices that I'm part of. The second aspect that's coming through quite strongly now is climate. And how do we deal with the climate risks that are coming through, whether they affect the agricultural economy or whether they affect the corporate economy, and what those knock-on effects would be for the cost of doing business in the future, and how do we mitigate against those. Now, climate risk assessment has actually been requested by the IMF to be included in bank assessments for lending. And that's a step that's been taken by many governments across our region, including India, including Bangladesh, including Singapore, Southeast Asia as well. And I think fundamentally there's a growing recognition that climate change is going to bring significant changes to the way we do business, the way we do agriculture, and the adaptation that we're going to have to do in the next 3 to 5 years to ensure that we don't end up in a perpetual cycle of loss and damage, which for Pakistan, unfortunately, in the last 10 years has been quite significant. Um, I think the other risk is obviously our own internal political risk, which we have seen with political cycles. We see that macro cycle also begin to exacerbate. And I think that's something that all three of those risks now are becoming very deeply ingrained into how business is done, particularly in the country. Now, what does this set us up for in the future? So one, as you can see, there is a lot of shift in the global macro environment. And what that means fundamentally for Pakistan is that there has been and there is going to be, I would say, a much deeper reliance on internal investment rather than foreign investment. In the last few years, we have seen foreign investment largely exit for reasons which range from their own internal decisions to decisions that relate excessively to the country. We have seen that in portfolio flows as well. And I think now the real shift that's going to happen for Pakistan post the IMF is going to be how do we capitalize on our own internal investment capability and using the liquidity that we have within the system to further our own investment mandates. Now, this happens on two levels. One aspect is obviously the government level, and the second aspect relates to the private sector level. If I address the private sector aspects first, in terms of what are the trends that we're seeing from companies and businesses that are in Pakistan, who continue to do business in Pakistan, how do they see the future going forward, and what will be their avenues of investment, or will they continue to just hold steady at the moment? So in most of the business surveys that I have come across, whether they come from entities such as the OICCI or the Pakistan Business Council that represent a large proportion of the businesses that are operating here in Pakistan, business confidence seems to be returning, not in a very strong way, but definitely returning up from lows of what we had last year. So a lot of the business consumer and the business confidence indexes that we see are on an uptick, meaning that there is more optimism about the current situation in Pakistan. And the investment climate seems to be stabilizing, if not drastically improving. The second thing that most businesses are talking about specifically is how to build in dollar revenue and how to build in export revenue. And this is coming in various forms and various interesting new sectors that we see developing, some of them very nascent, but certainly gathering and garnering quite a bit of attention, both from the policy side as well as from the private sector side. One of those sectoral trends that we're seeing is an enhanced focus on agriculture. And agriculture from the perspective of supply chains, from the perspective of storage, from the perspective also of R&D facilities, and also from the perspective of wanting to develop corporate farming mechanisms. All of these things are coming through in a number of food companies, in a number of entities that are branching out towards agriculture, both in terms of the upstream and downstream development. Now, this is all very encouraging. There is also a trend that we are seeing to vertically and horizontally integrate existing food processing and agricultural facilities. And again, some of this is happening in a more systematic way, some of it is more trial and error. But from what we can see is that there is a growing recognition of the need to preserve food security, particularly in the face of climate threats that are happening, and also to deliver more on the export side for our agricultural produce in a more value-added space. Now, these are all new developments, new projects, some of which, in my view, will take easily 2 to 5 years to come to full-scale fruition. But it is very encouraging to see that trend happening in a sector that has been largely underbanked and underdeveloped for many decades. The other area that we can see some potential coming through is there are financial institutions at the moment, especially if you look at the banking sector, sitting on very low ADRs, which means their ability to scale up on lending towards some of the more desirable sectors is slowly going to grow. And with interest rates coming down, that risk reward framework is slowly now tilting away from government crowding out effects in borrowing towards moving more towards the private sector, not just in short-term working capital lending, but also in longer term finance, project finance type lending as well. And the space that is available on balance sheet and the growth that we have seen in overall deposit basis is something that financial institutions, particularly banks, can certainly utilize to their advantage in the next 2 to 3 years. The third aspect for a major sector change is actually the energy change. And what we have in the energy sector at the moment in Pakistan is a huge organic shift towards renewable energy, in particular solar, but trends also towards wind and hydropower. I think just in the last 2 years alone, we have seen a massive pickup in solar energy to almost 20% of our energy generation. And this is coming about for a number of factors. One, of course, is wanting to reduce reliance on the grid, as well as net metering. And this is clearly causing some challenges on the government side as well in terms of managing the excess capacity that is there. So that is something I think policymakers are going to have to be very clear on in terms of the direction that renewable energy goes, given that we are now, in our view, in certainly an irreversible mode of that system change. And what we need is more policy that is supportive of that change rather than simply trying to dampen it, because I don't think that's possible at this stage in time. Congruent to that, the efforts that are being made on battery production, battery storage, EVs, both in terms of bikes and cars, those aspects have gone up, whether it is large-scale Chinese manufacturing coming into Pakistan, or we are seeing smaller scale indigenous battery plants coming in. All of that is actually happening on a fairly broad level across various different corporate groups looking to diversify into those spaces. And I do think the energy transition is something that globally has gained a lot of attention for Pakistan and is quickly becoming, I would say, a blueprint or a success story for the country in its transition towards using renewable and cheaper forms of electricity and energy. And I think the last point that I would raise here in terms of where businesses are diversifying into is really looking at the circular and waste economy and seeing how recyclables can be manufactured or produced not just for domestic consumption, but also for external consumption. This is something which a number of development finance institutions have been focusing on this market, particularly looking at biofuels, looking at the opportunity to export that, and looking at the opportunity to increase capacity within that as well. And finally, the data and the digital economy. If we look at InfraZaman's current portfolio, I would say that globally, our global portfolio, if we look at our pitch group in terms of the investments that we have made, almost 60% of our global book actually sits in renewable energy. But if you look at our Pakistan book, 60% actually sits in data, telecommunications, telco expansions, decarbonization of the telco tower businesses, etc. So it's a very interesting shift that we see in Pakistan, a heavy move towards data, towards improving digital connectivity and improving our backbone on the data side that is actually requiring that access to capital here, which is not the case internationally. So I think that's a really interesting story to tell, from the Pakistan perspective. Now, what is needed to support this kind of transition that we're seeing? And it's a very interesting transition because remember, for the last 60 to 70 years, we have really focused on the textile sector and a few manufacturing units here and there regarding various different assembly plants. That has really been the mainstay of our manufacturing. And very slowly, but very quickly, we are also seeing a shift out of those traditional sectors into very new high-tech sectors, which for us is an encouraging trend for the country as a whole. Now, what's missing in all of this piece? And we keep coming back to what would be the catalyst to move out of the IMF program. What's missing within this piece is really truly an access to finance for these businesses to scale up and to grow. At the moment, a number of projects that are what we would call new technology or new sectoral are getting their financing from international sources, whether it is development finance or whether it is DFI led in the form of the IFC or the World Bank, etc. But that is going to really dry up. These kind of overseas development assistance funds will really dry up over the next 3 to 5 years. They're already being put back simply because of Trump's climate agenda, which as we know, he does not subscribe to. So, what is going to need to increase is really our internal reliance and our internal ability to access finance. And that comes in many forms. One aspect is obviously the banking sector. And while the banks do have the ability to raise their lending books in favor of private sector credit, it is at an all-time low when it comes to private sector lend to GDP. It's under 15% at the moment for Pakistan. Internationally, other emerging markets similar to us in size are sitting at 50 to 60% of GDP in private sector lend. And that's a substantial difference. And I would say that's the primary reason we are unable to access that growth capital for companies. That is going to have to shift. And we're going to have to see how to address the risk reward basis of that shift to enable the banks and to encourage the banks to lend much more to domestic sectors rather than to the government, which is something which they're very comfortable doing. The other thing that's going to also have to shift is investor appetite domestically. If we pick up insurance companies, mutual funds, and life insurance companies, this is a significant pool of assets, all of which are generally focused on the 6-month and under treasury bill market. Now, these represent, if we look at our neighbor India, and we see how they have capitalized on this form of capital sitting in their own system, they have mandated and used different allocations and policy tools to encourage this form of capital to also lend longer term towards the projects and towards the companies that Pakistan needs to grow. And they've done that successfully over the last 10 years, and they have an excellent model, something which we should really look to see how we can adopt and push our long-term savings pool, which are now available within these markets, towards that form of investment. So I think the access to capital piece is going to be quite crucial if we want to see the country actually rely on its own sources rather than end up in another IMF program, because new businesses, high growth businesses all add to the tax pool, which is clearly a huge revenue problem for the government, along with export side, which is again a problem for the government. So, that's one area which I think we are really going to have to structurally focus over the next 3 to 5 years to avoid ending up in a low growth, high inflation IMF trap again. The other aspect that we're going to have to look at, and we are in a capital markets conference, or the capital CFA represents capital markets quite heavily, is look at the other aspects of capital markets. One is the debt capital markets. Interestingly enough, we are only doing 4 to 5 corporate sukuks or TFCs annually. That, given Pakistan's depth in terms of capital markets, is a drop in the ocean. And in the last 3 years, at least 2 of those issuances on an annual basis are guaranteed instruments, meaning without those, there would have been even less. So we are looking at a debt capital market that needs to be revived in terms of its vibrancy. Liquidity issues to be looked at, and the pricing issues also need to be addressed to encourage both more issuers as well as more investors into the debt capital markets. On the equity capital market side, I think we've seen a number of incentives come through on listings, but before we even get to the nursery, get to the listings, we need a nursery of corporates that are ready to list, and that only comes from the VC, the PE, and the angel investing piece that allows that access to capital for that growth. Interestingly enough, Pakistan has now seen a number of domestic PE funds come in, as well as few international PE funds looking quite closely at the country. However, more needs to be done in that framework to encourage that investment to stay and to also grow over time. So that piece on access to finance is really the next layer of growth has to come from the private sector and supportive elements of our economy, whether they relate to bank lending or additional or capital market access to finance. Those are needed to support that private sector to grow and be the revenue engine, both in terms of exports as well as taxes, because those two are really fundamentally the revenue generation problem that exists within the country and why we tend to move towards the IMF every 2 to 3 years. I'll stop soon, but in conclusion, I would like to say that the outlook at this point in time is more positive than it's been for the last 2 to 3 years. We need to build on the macro stabilization. A growth rate of 2 to 3% is not something Pakistan needs. We need approximately 6 to 7% annualized growth for the next 3 to 5 years to be able to generate that level of GDP growth, tax revenue, and export base so that we do not end up in the same cycle that we have been before. And I've highlighted some of the areas that need to be worked on and some of the trends that we're seeing within the business sector. So I'll stop there and I will pass this back to Sarvat and Naveen. I'm happy to address any questions. Thank you.
Thank you so much, Maheen, for your very comprehensive talk. And just to add a small statistics, when you talked about the neighbors, the CFA candidates with the neighbors is 40 times more than Pakistan. So the depth of the market really dictates a lot of ecosystem. So over to you, Naveen. Thank you so much for joining us. And yes, over to you.
Thank you so much. So really grateful for your insights, Dr. Salman and Maheen. And what's really refreshing is that both of you brought very complementary perspectives. So Dr. Salman started with a 30,000-foot view, and Maheen was more like, very grounded and very zoomed in into the Pakistani dynamics. So, a lot of things stood out for me, which I'll discuss in a moment, but we lead with an audience question. So there's supply chains are being redesigned as we speak. So my question, I think I'll direct this to you because this is very Pakistan specific. So Maheen can probably take this. So where do you see Pakistan in terms of, what aspects or what sectors can capture gains from a supply chain redesign that is happening that we see?
Yeah. So as I mentioned, several things, all of which are actually domestically driven. One, I mentioned agriculture. There is now, I would say, a lot of work being done by the corporate sector in the agri space itself, in particular on supply chain development, both in terms of storage or in terms of access to markets and working with farmers on access to credit, etc. It's not perfect, not by any means, but certainly the mushrooming of different solutions, different prototypes, different pilots that are being developed are very encouraging, and at some point those would land. So I think that sector is definitely in the last 2 years, the level of interest in that sector, both from an international as well as a domestic perspective, has gone up, quite tremendously. The other trend we're seeing is a much more localization of supply chains. And I think that's coming out as a direct result of the rupee movement that we saw back in 22 and 23, where a lot of manufacturing entities were very badly hit. One, with the closure of LCs, so the ability to import raw material, and the other, the inability to sometimes pass the raw material prices on towards the end consumer. What we did see there actually was a shift, and we've seen a number of multinationals as well as local companies look to see how they can develop the domestic supply chain to be able to meet, if not the entire, but at least 20 to 40% of the raw material requirement or within the system. So I think that trend is probably there in more in other economies as well. I think there's definitely a shift more towards looking inwards rather than expecting concessions from international community. That is a healthy trend, but does need to be supported through policy or through the ability of growth capital to develop the upstream, downstream supply chain issues that they are.
Thank you for that, and I agree totally. Dr. Salman, so would you like, the similar theme, but more from a textile-focused perspective and, the way Europe has been tightening the regulations around carbon. So how do you see that impacting Pakistani textile, very export-oriented industry?
Sure. So I think the trend is reversal there. I think the US retrenchment from climate change is starting to spill over into Europe as well. In fact, there is now a serious talk of dropping the ban on diesel and petrol cars by 2035. So I would expect geopolitics to become more bigger driver of relationship between countries, including of Europe, and all these restrictions and regulation driven systems to start changing towards what can countries do for us kind of thing, and where do they lie in the various blocks. So that's a trend. Obviously, it's not going to happen overnight, but that is the direction of travel towards less focus on absolute standards and more focus on geopolitics and supply chain reliability.
Okay, so while we're on to topic, I think how would you decide if something is structural, like, it resets the baseline versus something which is cyclical and, is more likely to return to baseline? Because that's what you said about Europe, right? That they are kind of reverting to baseline. So how does an investor or anybody who's allocating capital right now judge which of those shifts or which of those forces is more permanent or more long term, and which is like a temporary blip?
I think that's an important question, but I think I would suggest people read history a lot, because what we are seeing is actually 90% of human history. The last 15, 20 years, especially, were very abnormal in that regard. We see that in investment trends like the bond equity correlation point I mentioned. If you look at the data 1900s, 90 years or till GFC to pandemic look odd, not the other way around. So having, I think, a bigger, like a longest horizon helps. Understanding our own history helps as well. Last time these kind of big changes were happening, India and current day Pakistan got colonized as a result of it. Um, so I think it's about taking a step back and trying to understand history. Obviously, history never repeats, but it rhymes, and there are some clear patterns which are appearing, which suggest that this is quite deep rooted. So one couple of things I would flag is, for example, the immigration point I keep highlighting. Um, as I mentioned, this is a very popular policy, no matter what media you are hearing. And the problem is that because of social media and selective echo chambers, people think what they read is the reality, whilst, you have to basically broaden your horizon. You have to look at alternative voices, um, and be very careful between the difference between opinion and analysis. And I think this is the age of analysis, and opinions are in massive oversupply, whilst analysis is in big shortage.
Okay, so yes, great insight again. So Maheen, I would like to, sort of drill down more into what Dr. Salman said. And what do you think is one factor that people think affects global capital flows or even local capital flows, but in your opinion, or in your experience, it's not really relevant. It's more of noise than affects actual capital flows. For example, we just spoke about, right-wing populism and whatever. So Dr. Salman strongly feels that, that is a lingering or enduring trend, and that, that will continue to affect capital allocation decisions, how capital is priced, how it is protected. So what do you think is something which is just noise, pure noise, and doesn't affect, investment decisions at all?
So for Pakistan, international flows haven't been very strong, and they don't constitute a large portion of our sort of our annual, our annual FDI is quite low, and even our annual portfolio flows are quite low, right? So we're not a recipient of a flight to capital to either return or safety, right? We are sort of a little bit ignored by the international flows in that true sense. But if you look at the capital that does come to Pakistan, there is foreign direct investment that has been here for the last 30, 40 years and continues to stay here. The new flows or the flows that we tend to attract are very much development flows, whether they come in the form of fiscal support, such as you see from the ADB, or they come in the form of World Bank support for large infrastructure or PPP related projects or federal government projects, or they come from DFIs who are looking to make commercial investments in the country, which are linked with their development mandates, right? So that's the bulk of sort of, I would say, the international capital flows that you see coming up here. And that's, I would say, more a function of the availability of projects in Pakistan that fit that framework rather than an international move of commercial capital. So we are a little bit insulated from that cycle and always have been, because we're not a huge attractor of commercial international capital. When I look at Pakistan's domestic capital flows and where that goes, easily 70 to 75% goes to the government of Pakistan, regardless of the interest rate cycle that you're sitting in. Naturally, if you're going to be at the top of the interest rate cycle, that's 20 to 22%, which is what we saw back in 23, 24, then, the risk towards the private sector effectively becomes, something which is not justifiable. And you will see that trend heavily move towards the government security side. When you flip that and you look at that today, where we're sitting in terms of 10 odd percent interest rate, 10 to 11% interest rates, you can begin to see slowly that government reliance come down. Or you can see the interest rate move down. And with that, slowly you begin to see more interest in private corporate debt. But I would say still 65 to 70% of interest continues to sit in that 6-month, 1-year Treasury bill, 3-year PIB type of category, right? So, that's our fundamental problem, that the government is fundamentally crowding out the bulk of investment flows internally in the country. And unless we shift that and we move that into the private sector, which has the capacity to pay tax and to bring forward exports, you're not going to be able to move the revenue needle much for the country, right? So that's where we sit in a very sort of very high level way of how investment decisions get taken as far as the country is concerned.
Okay, so we have an audience question for you. And this is about basically the fiscal discipline that you mentioned that we've seen for the past 2 years at least. Do you expect that to continue post IMF? And it's anybody's guess, but anyway. So do you expect that to continue? And other than fiscal discipline, do you think on the policy making side of things as well, for example, renewable energy policy or climate related things, which really should be front and center right now, human development should be front and center right now, where do you think policies will sort of give way to populism? And what are those points where we should expect a breakdown post IMF?
Well, I think we've seen that story many times, so I don't want to get into where the potential breakdowns can happen because we've seen that happen multiple times. But maybe what will shift, right, is, our policy tends to be very much, let's ban this, let's increase tax on that, very, hard black and white policy, right? What is going to move the needle towards incentivizing more of what we want to see, right? Right now, there's very little incentivizing. There's a lot of, if something moves, tax it philosophy, or if something we don't understand, let's ban it philosophy, right? So if we can somehow shift our thought process and think about what are the sectors that we want to incentivize? Where is it that we want capital to flow? Ultimately, there is a sense on both government, private sector, that things cannot continue in a constant IMF cycle. Now, whether that realization translates into policy decision making that is long term, that is at this point in time anyone's guess. There have been lessons learned, but how we translate that into long term deliverability of long term policy frameworks, I have yet to see that really come through in a meaningful way. The other thing I think that we've been advocating, and others have been advocating for, is if there is a desire to create an economy that adapts to climate risk, because that is becoming something that no one can ignore, whether that's the government or the private sector. We cannot ignore the climate risks anymore. But if we want to encourage investment towards climate adaptation projects, we should be incentivizing that in a big way, rather than simply laying out the starting point is laying out the green taxonomy, laying out the climate finance framework, but also actually encouraging people to do it. I mean, at this point in time, there have been green issuances in the corporate debt market, but they have come because those companies specifically are mandated to do green, or they're mandated to do sustainability. But the broad private sector, the broad commercial investor, is neither incentivized nor mandated to look at either sustainability or climate finance as an agenda point for themselves. So perhaps it's the time to really, if we want to be investing in Pakistan's climate readiness, then it's time to bring those incentives forward, and then that encourages the rest of the private sector to follow suit. So, and similarly with energy transition, I think that's actually caught the government off guard in terms of how quickly the organic process of switching off from the grid, has happened. And while they are now trying to control that through, looking at various net metering tariffs, or looking to see how they can reduce that, or reduce the speed at which this is happening, I think we've gone beyond the point of no return on that. And even if there is that desire to reduce the net metering rate, all it would encourage at this point in time is simply an increase or an improvement in battery storage capability. So sometimes you cannot fight the organic trends that are already there in the country, and you have to work to create policy that supports it. Otherwise, you will end up with creating huge, debt burdens and costs for yourself as well. So I think slowly that realization is coming through. I also think the IMF is certainly pushing towards longer term reform, which, if that reform does come through, whether it's on taxation or energy, or any of the points that I've mentioned, should stick, long term as well. Otherwise, we will end up in that same cycle. And ultimately, Pakistan's problem is one of revenue, not enough export revenue, not enough tax revenue. And that solution is really only in the private sector to take forward.
Great. So, Sarva, do we have time for one last question?
Okay, so if you can, a quick one, yeah, sure.
Okay, so a very quick one, right? Dr. Salman, you led with AI, so I have a follow-up question. So we know that AI will alter return expectations for the market broadly as well. And the value is all concentrated around data and scale. And so which economies do you think, which are your top 3 economies, do you think, who will capture the productivity gains as well as the capital flows over the medium term? Are there any unexpected players?
I think right now it's a war between US and China. They are the 2 main ones. They're financing themselves with their own capital, a lot of them. The innovation is happening in these 2 countries. I think the second tier would be, how does other countries start connecting to the wider supply chains and the wider technology transfers? And that is going to become a question of geopolitics, really. Who are you comfortable using, sharing your data with? Because algorithms are going to become much more powerful. So it's questions of, those sovereignty questions going to start becoming more important. But there are clear losers out of it. So the losers are obviously the young cohort of graduates. We're already seeing unemployment rate going up, back office outsourcing, freelance model in Pakistan is going to die probably in a year or 2. Translations, all that stuff is going to go away. So the question is, can we connect to this new, technology wave, given the fact that we missed the old one? So we are not going to get much damaged by it, because we didn't never invested in it that much. But the question would be, how do you connect to that wave? And Europe will be is the dark horse. I mean, do they do something serious about AI, cloud, and data, and data sovereignty? But ultimately, it's a war between US and China. I mean, there's nobody else in the scene right now.
Okay, thank you so much for your insights. Over to you, Sarvat.
Thank you so much, Dr. Salmaya. I understand were on vacation. Thank you for taking time out. Thank you, Maheen, and thank you, Naveen, and thank you all of the participants.
Thank
Allah
you.
Hafiz.
Thank you.
All right.